December 23rd, 2008. Elon Musk had 3 days left. Tesla had million in the bank. They were burning million a month. SpaceX had just survived its fourth rocket launch after 3 consecutive failures. Both companies were weeks from bankruptcy. And Musk was out of money. Not rich guy running low money. Actually broke. He'd spent million from the PayPal sale. Million into SpaceX, the rest into Tesla. He was borrowing from friends to pay rent. His wife had just filed for divorce. The press called him delusional. On Christmas Eve 2008 at 6 p.m., Musk made a decision that would either save both companies or destroy them. He invested his last million into Tesla. Not million, not half, everything he had left. Here's the part nobody tells you. The money wasn't enough. Tesla needed million to survive. Musk only had million. So he made the other investors a deal. I'll put in my last dollar. You match me, or we both lose everything.
They matched.
The funding round closed at 6 p.m. on December 24th. Tesla was 3 days from bankruptcy when the wire transfer hit. This is not a story about luck. This is a story about capital allocation under existential uncertainty, about using personal risk as a signal when words stop working, about the mechanics of staying alive long enough for one rocket launch to change everything. Most people think Elon Musk got rich by building electric cars and rockets. Wrong. He got rich by refusing to dilute equity when everyone told him to walk away. Go back to 1999. Elon sells Zip2 for $1 million. His cut? Million. He's 28 years old. Most people would diversify, buy real estate, set up a trust fund. Musk invests million into X.com, an online banking company nobody asked for. Why? Because he believed payment infrastructure was broken. Credit cards charged 3% per transaction. Banks moved money in 3 business days. The internet needed instant, cheap payments. .x.com merged with Confinity in 2000. The board voted Musk out while he was on his honeymoon. The company rebranded to PayPal. eBay bought it for $0.5 billion in 2002. Musk's stake after dilution, million. Most people would stop there, set for life. Maybe angel invest, enjoy it. Musk did the opposite. In 2002, he founded SpaceX with a single goal: reduce the cost of launching a kilogram to orbit from $10,000 to under $1,000. Reusable rockets, private space industry, eventually Mars colonization. The entire aerospace industry laughed. In 2004, he joined Tesla as chairman, investing millions more. The company wanted to prove electric vehicles weren't golf carts. By 2006, both companies were burning cash with no revenue. SpaceX built the Falcon 1 rocket, small, cheap, expendable for now, but designed to test systems for the reusable Falcon 9 later. March 2006, Falcon 1 launch attempt number 1. Fuel leak. Engine fire at T plus 25 seconds. Million rocket destroyed. July 2007. Launch attempt number 2. Roll control glitch. Second stage failed. Million gone. August 2008. Launch attempt number 3. First stage slammed into second stage after separation. Million destroyed. 3 failures. SpaceX had 8 weeks of runway left. Musk had poured over $1 million of his own money into the company. If the 4th launch failed, SpaceX would declare bankruptcy. The team had 2 months to diagnose the problem, fix it, and relaunch. Here's what you need to understand. Most founders at this point would pivot, raise emergency capital, negotiate with creditors, cut scope. Musk moved to the launch facility. He slept in the SpaceX office on Omelek Island. He embedded himself in every technical decision. No consultants, no committees. Just engineers and the CEO working 18-hour shifts to figure out why the thrust vector control kept failing. September 28, 2008. Falcon 1 launch attempt number 4. The rocket reached orbit. First privately developed liquid-fueled rocket to achieve orbital velocity. 3 weeks later, NASA awarded SpaceX a $0.6 billion commercial resupply services contract. SpaceX went from failed startup to NASA contractor overnight. But here's the problem. That was September. By December, the 2008 financial crisis had frozen credit markets. Lehman Brothers collapsed. GM and Chrysler declared bankruptcy. No venture capital was flowing. Tesla's existing funding round fell apart. Tesla had $4 million left. October 31st, 2008, burning $1 million per month. 6 weeks of runway. Musk tried to raise an emergency Series E. Investors said no. The car industry was imploding. Why would anyone bet on an electric vehicle company with no path to profitability? December 2008. Musk had to choose. He had millions left in liquid capital. SpaceX had just been saved by the NASA contract. Tesla was dying. He could invest everything in Tesla and let SpaceX survive on the NASA money, or he could split the capital and risk losing both companies. Here's where most people misunderstand what happened. Musk wasn't betting on Tesla's technology. He wasn't betting on electric vehicles becoming mainstream. He was betting on a signal. He put his last $1 million into Tesla. Then he told the other investors, "This is everything I have. If you don't match me, we both lose. If you do, we survive until the next milestone." This is capital allocation under existential uncertainty. The principle? When words stop working, personal risk becomes the only credible signal. Investors don't trust projections during a crisis. They don't trust market research. They don't trust anything except one question: will the founder go down with the ship? Musk's $1 million answered that question. The other investors matched. $1 million total. The round closed December 24th, 2008 at 6 p.m. 3 days. If Musk had hesitated, if he'd tried to negotiate a lower personal commitment, if he'd kept $1 million as a safety net, Tesla would have declared bankruptcy on December 27th. Here's what makes this decision extraordinary. Musk was simultaneously broke and committed. Court filings from February 2010 show he was borrowing $1,000 per month from friends just to cover personal expenses. He had no house, no liquid savings. He'd pledged his Tesla stock as collateral for personal loans. And he wasn't just sitting in an office making capital allocation decisions. During the 2017 to 2018 Model 3 production crisis, when Tesla was ramping manufacturing, Musk slept on the factory floor in Fremont. Not a hotel nearby, the factory floor. He was debugging production line bottlenecks at 3 a.m. When people asked why, he said, "My commitment has to be visible. If I'm asking workers to do 12-hour shifts, I have to be there longer." This is not martyrdom. This is signaling. When you invest your last dollar, when you sleep in the office, when you pledge your personal assets as collateral, you're sending a message to everyone watching: I'm not going to quit. And that changes the math for everyone else. Employees stay because they believe you'll figure it out. Investors double down because they see you're committed. Partners negotiate better terms because they know you're serious. May 2009. 5 months after the Christmas Eve funding round, Daimler acquired 10% of Tesla for $11 million. Daimler, the parent company of Mercedes-Benz, betting on a tiny electric vehicle startup in the middle of the worst recession in 80 years. Why? Because Musk's Christmas Eve decision had sent a signal to the entire automotive industry. Tesla wasn't a hobby. It wasn't a side project. It was existential. Daimler later sold that 10% stake. If they'd held it until 2026, it would be worth billions. June 2010. Tesla went public at view per share, raised $1 million, provided liquidity for early investors and employees. SpaceX, meanwhile, continued developing Falcon 9. First successful landing in 2015. Reusable rockets became reality. By 2026, SpaceX is valued at approximately trillion. Tesla is valued at 0.3 trillion. Musk's net worth? Billion, as of February 2026. But here's the thing people miss. The wealth isn't the point. The decision that mattered happened in December 2008, when Musk chose to refuse dilution. Capital allocation under existential uncertainty, preserving equity through personal leverage. One sentence. When survival is uncertain and investors are skeptical, personal financial commitment becomes the only credible signal, and preserving equity during that crisis creates asymmetric upside if you survive. Here's the mechanism. Standard startup advice. Raise capital early, dilute gradually, preserve runway. Don't risk personal bankruptcy. Musk did the opposite. He delayed fundraising as long as possible. He invested personal capital first. He operated at the edge of bankruptcy to force focus. And when he finally raised capital, he did it at inflection points. After Falcon 1-4 succeeded, after the Christmas Eve commitment, after Daimler validated Tesla's credibility. Result? Musk maintained control. At SpaceX, he owns 42% equity, but controls 78 to 79% of voting power through dual-class share structure. At Tesla, he maintains significant control despite dilution. Why does this matter? Because preserving equity during the crisis meant he captured the full upside when both companies succeeded. If Musk had diluted down to 10% ownership in 2008 by taking easier money earlier, his Tesla stake today would be worth approximately billion instead of approximately billion. If he'd sold SpaceX to Boeing or Lockheed Martin in 2008 to avoid bankruptcy, he would have captured zero of the trillion valuation in 2026. The principle? Refuse dilution when survival is uncertain, even if it means personal bankruptcy risk. 3 specific examples. Example 1. The Christmas Eve decision, 2008. Musk invested his last million into Tesla instead of keeping it as personal safety net. This forced other investors to match, preserving his equity stake at a critical moment. If he'd negotiated for lower personal commitment, other investors would have demanded higher equity in exchange for higher risk. Example 2. The dual-class structure, 2002 to 2026. Musk structured SpaceX with dual-class shares from the beginning. 1 share he owns equals 10 votes. 1 share investors own equals 1 vote. This allowed him to raise plus billion in capital without losing operational control. Result? He could make long-term bets, Mars colonization, Starship development, that public markets would never approve. Example 3. Personal collateral as signal, 2008 to 2010. Musk borrowed $1,000 per month using Tesla stock as collateral instead of selling equity. This kept his ownership percentage intact while demonstrating commitment. When Daimler invested in May 2009, they cited Musk's personal risk as evidence of credibility. The principle works because of psychology. Investors during a crisis aren't rational. They're terrified. Data doesn't convince them. Projections don't convince them. The only thing that works is proof you won't quit. Personal financial commitment is proof. If you invest your last dollar, you can't quit without losing everything. This paradoxically makes you more credible, not less. But, and this is critical, the principle only works if you survive. Musk's strategy required both companies to survive past their crisis moments. If Falcon 1-4 had failed, SpaceX declares bankruptcy and Musk loses everything. If Tesla hadn't closed the Christmas Eve round, same outcome. The risk was real. The strategy isn't replicable for everyone. Your move. 3 actions. For business owners, delay fundraising until after you hit inflection points. First revenue, first major contract, first successful product launch. Capital is cheaper after proof. If you raise too early, you're selling equity at the worst possible price. Exception: if your runway drops below 3 months, survival beats valuation. For career decisions, when you're negotiating equity compensation, ask, what percentage of the company does this represent? Absolute share count means nothing. Equity percentage and control rights, voting, board seats, liquidation preferences, determine whether you capture upside. If you're joining a startup, negotiate for larger equity percentage instead of higher salary when you believe in the mission. For investors, watch for founder commitment signals during downturns. Founders who invest personal capital alongside you during hard times are statistically more likely to succeed because they're signaling non-negotiable commitment. Red flag: founders who preserve personal liquidity while asking you to invest during a crisis. That's not partnership, that's asymmetric risk. One final thing: Musk's 2022 Twitter acquisition cost billion with billion in debt. The company is now worth minus $20 billion. He lost 50 to 70% of the investment. Why? Because he violated his own principle. He used leverage to acquire a mature company instead of preserving equity in a growing one. Twitter wasn't at an inflection point. It wasn't about to break through. It was a personal bet on ideology, not capital allocation. The principle works for building. It fails for acquiring. December 2008. Elon Musk had 1 million left and 2 dying companies. He made a decision that sounds insane: invest everything instead of walking away. That decision created $0.3 trillion in combined company value over the next 18 years. Next time someone tells you to diversify, to play it safe, to preserve your personal liquidity during a crisis, remember Christmas Eve 2008. Sometimes the only way forward is all in. In the next episode, we'll look at another founder who faced a similar choice but made the opposite decision, and why it worked. Not every crisis demands personal bankruptcy risk. Sometimes walking away is the right capital allocation. Stay lucid.